Okay, good morning, good evening to those of you who are connected online as well as those of you who are here in person. My name is Yasuhiko Matsuda. I am the country manager for the World Bank here in Kuala Lumpur and heading the Inclusive Growth and Sustainable Finance Hub housed in this building Sasana Kijan as part of the Malaysian Central Bank, Bank Negara Malaysia. Today, we have a pleasure of introducing our colleague, Dr. John Buffis. He's our senior economist in the World Bank's Global Prospects Group, which is part of the World Bank in Washington, D.C., that publishes reports on global economic outlooks and commodities and so on. John can briefly describe what the unit does. John heads the commodities unit of the Prospects Group, and he is a specialist in commodity market issues. I understand that you used to manage commodity market trading company, was it?
For a couple of years, yeah, after college.
Yes, and he also has a PhD in economics, specialized in this area. So we have a true expert in the matter, and of course, the commodities are important for Malaysian economy, oil and gas, and other commodities for exports. I'm not sure palm oil counts as commodity. Technically, it does. Yeah?
It does.
But also, it's heavily dependent on imports of food and so on. So the things happening in the global economy today are of high interest and relevance for Malaysia. So without further ado, John, thank you for joining us, and over to you.
Okay. Thank you, Yasu. Thanks a lot to the Malaysia team for putting this event together, especially in such a short notice. I'm a senior economist in the World Bank's Prospects Group. Our group monitors the global economy, various aspects of the global economy. We have two main publications. One is the Global Economic Prospects, which is published twice a year, January and June. And our second important publication is the Commodity Markets Outlook, which I'm going to present today. We publish this report twice a year in April and October. This edition was published just a few days ago on October 26th, so I'm in a position to give you the latest update on global commodity markets. From a commodities perspective, we also publish a commodity price report. We publish it once a month on the second business day of the month. And we also publish a number of volumes on the macroeconomy as well as on commodity markets. I will elaborate on those aspects at the end of the presentation if time permits. Let me now begin my presentation. As I said, what I'm going to talk about today reflects the findings of the Commodity Markets Outlook that we posted on October 26th. Just to give you an idea of what are the kind of key messages from the Outlook. The first big issue in commodity markets or the global economy more generally is that we are facing a sharp global growth slowdown that certainly is going to affect commodity markets and commodity prices. But I have to highlight one issue is that the dollar has appreciated quite a bit recently, the past 2 to 3 quarters, and that affects commodity prices in domestic currency terms. So although we have seen some kind of retreating in commodity prices in dollar terms, there has been quite a big increase in some countries in domestic currency terms. So that's a very important point to highlight. In terms of what we expect, in terms of price forecasts, for 2023, we expect energy prices to decline a bit more than 10%. And let me mention here that when I discuss in this presentation and the report in general price forecast, we are talking about annual averages from January to December. So again, in 2023, we expect energy prices to be to fall at about a bit more than 10% in 2023, and a further 12% in 2024. Brent prices, that is crude oil, which is of course the most important commodity, we expect it to average $92 a barrel next year, $100 per barrel this year, and we expect a further decline in 2024 to $80 per barrel. Now, moving to non-energy commodities, We expect declines in both agricultural and metal prices for next year, 5 and 15% respectively, but we expect prices to stabilize in 2024. Now, those are the numbers that we expect. Of course, there are huge risks around those forecasts, and especially the risks are numerous this time around. Most importantly, on the energy side, the big issue is what happens energy supplies from Russia, which have declined significantly. We also have the issue of the price cap. We have the issue of the Europeans which do not want to insure, they will ban insurance of transport of oil, which effectively ban oil imports to Europe. And of course, the other risks in Europe especially is what happens in this winter in the weather. Europe has managed to build up its inventories in natural gas, but a lot can happen if there's a harsh winter. The other important risk is that if we have higher than expected energy prices, that's going to affect non-energy commodity prices, especially the ones that depend a lot on, they have a strong link with energy prices. Food insecurity could intensify. Grains and oil seeds are energy intensive commodities in the sense that they use a lot of energy to be produced. So if we have an upset in the energy markets, that could certainly affect food commodity prices and food security. On the downside, the big question is the global slowdown. The news on the global growth gets worse and worse. Since January, when we published our global economic prospects report, every month we and all other agencies, the national agencies and investment banks, have been downgrading the global growth. So the news there are getting darker and darker. And lastly, we have the issue of the appreciation of the US dollar. As I said earlier, the dollar has appreciated a lot, and that puts a lot of pressure both on commodity prices in domestic currency terms, and of course, that means inflation. Let me now move to more specifics and look at the commodity price and how have they have behaved. In the shaded area to the right, you see the period which is after COVID-19. When we monitor commodity prices, we divide them into, we monitor them into three categories: energy, agriculture, and metals. Energies are the obvious suspects: crude oil, coal, and natural gas. Metals is the metals that we all know: copper, aluminum, zinc, lead, etc. And agriculture is a very broad index which contains both food commodities such as wheat, maize, rice, palm oil, etc. But it also contains what we call beverages such as coffee and tea, as well as raw materials such as cotton and natural rubber. So this is a very broad index, agricultural index. We do see here the behavior of commodity prices that perhaps most of you are familiar with: a decline in the early stage of COVID-19, a sharp recovery afterwards. The decline was most pronounced in the energy markets, especially crude oil. And then we had a huge recovery, partly in response to the greater than expected recovery in the global economy after COVID-19, or rather during COVID-19, as well as a number of supply disruptions that took place in various commodity markets that pushed oil prices up. Energy prices kept going up until very recently. However, agricultural and metal prices kind of retreated, and now they reached the levels that were about 2 years ago or a year and a half ago. As I said earlier, this is the picture of what I'm showing now on commodity price in US dollar terms, but when we look at domestic currencies, the picture is quite different. For example, we have taken here the price change of oil and wheat between February and September 2000. Yes, please.
I have a question.
It's fine with me, as long as...
yes. If there's any immediate questions needed for understanding.
Yeah, like on the previous graph, like what explained the reversal again in the...
I'll elaborate for this. Okay. Yeah, that's fine. That's my presentation, basically. Yeah. Yes, thank you. Here we are seeing the price of oil and wheat in between February and September 2022, and to the right you can see the percentage change in US dollar terms, which in the case of oil it's down 6%, and in the case of wheat it's up 7%. Not much of a change, again, between February and September of 2022. Now, when you look at how those prices moved when we translate them in domestic currency terms, and just to highlight here that we just take the world price adjusted by the exchange rate. It does not necessarily mean that this is the price that consumers pay or producers receive. There are a lot of steps between this and the other price, but nevertheless, the picture here is quite revealing in the sense that we see huge price changes across many countries, and you can see here that the price increased across the board, whether they are emerging and emerging and developing economies or advanced economies. Across the board, we have the huge increase in domestic currency terms. Let me now move to what happened in the energy markets. I will first look at energy markets, then a bit of metals, and then agricultural. Those are the three big markets I'm going to examine for the rest of the presentation. We see to the left the price of crude oil for the past 4 years, the post sort of COVID-19 recovery and the decline that we saw recently. There are three kinds of events that have shaped the behavior of commodity prices. All commodity prices, but especially energy prices. The first is that with a sharp increase in energy prices, in oil prices, a number of countries engaged in releasing the reserves. In the picture to the right, we see the red line shows the crude oil inventories in the SPR, the Strategic Petroleum Reserve in the United States. And you can see that we were at a peak in 2008, 2009, but since then, more than half of the SPR from the United States has been released. So that's one of the reasons why we see a moderation in crude oil prices. In fact, the SPR in the United States now has reached levels that were not seen since the late 1980s or early 1990s. So we have a lot of inventories that have been released into the market. When we look at two other factors that affect oil prices, one is what happens in OPEC, and the other is what happens in the oil sector of the United States, the US shale oil industry. Now, on OPEC, what we see is that we measure actual production against the quotas in the chart to the left. And what we see there is that although, for example, OPEC on its October 5th meeting decided or agreed to reduce, OPEC Plus rather, to reduce oil production by 2 million barrels per day. In fact, what we see here is that a lot of countries, OPEC Plus countries, operate below, they don't have the capacity. So in fact, OPEC Plus said that they're going to reduce it by 2 million barrels per day, but in fact, the reduction is going to be at most 1 million barrels per day. Simply, countries do not have the capacity to produce. But nevertheless, there's quite a bit of tightening coming from the supply side, from the OPEC Plus side. Now, what happens in the United States is that the US, apparently with a shale revolution, the past 10 years became the largest producer, or the world's largest producer of oil. But what we have seen recently is that despite the fact that prices exceeded $100 per barrel for a number of months, the US shale oil industry has not responded as expected. It has much weaker response than what we expected. And there are a number of ways to look at it. We have two metrics here. One metric is the rig count, which in a sense measures the active, so to speak, oil extraction operations in the United States. We do see a recovery, but that's the blue line, but it has not reached the levels that we experienced 4 years ago. So it's far below the 4-year levels of 4 years ago. Another metric is what they call drilled but uncompleted wells. So those are wells that could come in terms of producing oil at a very short notice. Again, we see that there are not that many of those wells, again, in the US shale oil industry in the United States. So from those two metrics, we can clearly see that there has not been much supply response in the United States, as expected at least. There are two reasons for this. The first reason is that when the shale oil boom took place in the United States, most of the operations were owned by oil operations, were owned by smaller companies. And those companies were eager to produce more oil, and they also got a lot of financing from banks. They were producing a lot of oil. But what happened in the 2014 price collapse, a lot of those companies went out of business. Then some of those were purchased by large oil companies, the majors, as we call them. And there's a key difference between the smaller operators versus the large companies. The large companies, they are not interested in producing more oil. They are more interested in delivering returns to their shareholders. And that's why they do not produce as much as the smaller, small companies, so to speak. So that's one key difference. And the second key difference is that the banks, because a lot of operations went out of business after the 2014 oil price collapse, they are very reluctant to lend money to the USA oil industry. So you have issues both on the financing side as well as on the objectives of the companies, or at least for half the oil USA shale production. And that's why we see to the right that there has not been as much supply response in the United States. Now, what caused so we see that there are issues on the supply side here, but what caused the moderation in oil prices, which is your question, is global growth. We have bad news, dark clouds, so to speak, in the global growth. And although we have constraints on the supply side, at this stage at least, the demand side kind of imposes more pressure on the price of oil, and that's why we see this moderation in prices. Let me move to the other two commodities, energy commodities, which is natural gas. The first is natural gas. Natural gas experienced huge price increase, especially in Europe. Natural gas prices increased by a factor of even 10, I would say. You can see this is the scale to the right, that natural gas was in Europe was traded at something like $5 per unit, the British million British thermal units, which is the unit measuring the natural gas. It was trading as low as $5 or $6 back in 19 and 20. Prices began increasing in late 2021, and at some point it reached $70. It went up by a factor of 12. That's the European prices. We did see increases in the United States, but not as much. The United States, which is the scale to the left, prices about doubled there. Of course, the big reason here in US the natural gas price is the Russian the war in Ukraine, that a lot of gas supplies were shut down from Russia to the European Union, many European Union countries. That's why we see the huge price increases. But we also should mention the fact that prices increased prior to February. They increased quite a bit. Two reasons why they increased prior to February is that first, Russia had already reduced its supplies even prior to the war in Ukraine. That's the first reason. And the second reason is that we had a number of adverse weather events that affected hydroelectric production around the world. That is in Brazil, South America, China, as well as North America. And that drove prices. Because of those problems, there was less hydroelectricity produced around the world. So a lot of countries' electricity generation facilities began using both natural gas, LNG, and coal. That's why we saw those prices increase, in addition to cutting supplies from Russia. Now, in the European Union, most European Union countries took aggressive efforts after the war in Ukraine. They took aggressive efforts to replenish their inventories. And we can see in the chart to the right, the dark blue line marked 2022, that the inventories currently are much larger than what they were in 2021, but they are even larger inventories compared to the 2017-2021 average, which means that if the weather in Europe, the winter rather in Europe is mild or average, European countries will get by quite well, unless there's harsh winter, in which case they may have face problems. But even under a harsh winter, we don't think that Europe is going to face problem this winter. But again, that doesn't mean that problem is not there. Issues in supplies of natural gas and energy in general will persist in Europe for years to come. And then the third energy commodity, which is coal, again, it's a familiar pattern as we have seen in all other energy prices. To the left, we see the coal prices, which were averaging around $100 per ton up to early 2021 or late 2020. And since then, again, coal prices, for the reasons that I just mentioned earlier, skyrocketed, and currently they are trading between $400 and $500 per ton, almost 5 times as much as the long-term average. We have seen a lot of activity in the coal market, both on the production side and on the trade side. Two aspects that I would like to highlight in the coal market. Again, the first is what I said earlier, that because of weather problems in hydroelectricity generation, low supplies of natural gas from Russia to Europe, that also pushed coal prices up. But in the chart to the right, we also see that there has been quite a bit of slowdown in new coal plant additions for obvious reasons, because of climate change and the efforts by countries to reduce their reliance on coal. And that's why we see to the right for the past 10 or so years less and less new capacity coming to the coal market. And that, of course, is a longer-term issue. But now that we have disruptions in the natural gas market, we see that there's a problem in terms of supply of energy. So this is good news from the environmental perspective, but bad news from energy supply perspective. That's also very important to keep that in mind. That's in terms of energy market developments. Quickly, let me move to metal markets. Metals is a group of commodities that respond very closely to the global economic activity, rather to the economic activity. I will elaborate on this. And to the left, you can see what we call the PMI, the Purchasing Manager Index, the global manufacturing PMI that sort of started weakening since January 2021. And that, of course, affected prices as well, the metal prices. To the left, we have the metal price index, and that affected pretty much metal price across the board, both base metals, which are aluminum, copper, zinc, etc., as well as the ores. But here in the chart to the right, we show the iron ore. So for the past 3 quarters, metal prices have declined quite a bit. A lot rather. In fact, it's a group of commodities that has been hit the hardest in terms of prices. And that's because of the global economic activity. Now, let me elaborate a bit more on metals. And first, let me say that metals depends a lot on what happens in China. China today accounts for nearly 60% of global metal consumption. That's 60%, almost 2/3 of global metal consumption. This number, this percentage used to be only 5% back in 1995 or later. So China is basically dominating the global metal consumption. And to the left, we have the chart which shows China's property market. Most of you may be familiar with the troubles that are facing this property market, both commercial and residential real estate market in China. China also has the issue of zero COVID-19 policy, and it slowed down the property market in conjunction with the zero COVID-19 policy. We have seen the property market indicator, one of the many indicators that are monitored, to plummet, and now it has reached the lowest level in a year-on-year percent changes since 2014. So, in other words, when we talk about metal markets, we basically talk about the prospects of the China economy. And you can also see to the right where we are showing the year-on-year percent change, and that's monthly data on metal consumption. We divided it into OECD, China, and the other OECD countries, and you can see that for the past 10 or so quarters, China, which is the red portion of the chart, either it's negative or whenever it's positive, it's very small. And that, of course, mimics, in a sense, matches well the chart to the left for the troubled, so to speak, property market in China. Before I move to agriculture, I'm going to show you just one chart that I find very interesting in precious metals. Precious metals prices have declined quite a bit recently, especially gold and silver. A number of factors affect precious metals. It's a very interesting market because there are precious metals and they are going, of course, for consumption, for investment purposes, especially gold. But some of the precious metals are also used in various industrial activities, especially car manufacturing, microchips, etc. So precious metals also respond quite a bit to the global economic environment. Now, one might think that if there are bad news, you have inflation, you have low growth, etc., metal prices, especially gold price, would go up. But what we see in the chart to the right, we see that gold price especially respond a lot to interest rates. So that's the dominant factor. Although one would think that because inflation, people would get into the precious metals and gold, this is not the case, as we see to the right. By the way, the real interest rate to the right is an inverted scale, so it's up. We just have it too much interest rates. So high interest rates and headwinds from global growth have affected most precious metals markets as well. Let me move to the third part of the commodity groups that we are monitoring, and those are agricultural markets. Again, here we see the agricultural price index, which we have divided into three parts, into the food commodities, rice, wheat, palm oil and soybean oil, etc., beverages, coffee and tea, as I said earlier, and raw materials such as cotton and natural rubber. We see relative stability or even decline in raw materials, not surprisingly, because this index responds a lot to the global economic activity. This index, the red line, mimics the behavior of metals. Then in beverages, we would have seen stability there, same as in raw materials, but what happened is last year there was a bad crop in coffee in Brazil, and that affected a lot. The coffee price went up by a factor of 3, and because the coffee price is very important in the beverage price index, that's why we see this uptick in beverage price index. And then we have food prices, which pretty much skyrocketed after the low in the early stages of the pandemic. They reached a peak in the first quarter of 2022. Now, there are two main reasons of why food prices increased. First, we had some supply issues, weather-related supply issues in North America, which affected maize quite a bit, in South America, which affected soybeans a lot. And then the war in Ukraine came, that gave an even more upward pressure, exerted more upward pressure in food prices. They reached a peak, I believe, first or second quarter of this year, and since then food prices have come down. Two reasons of why they've come down. The first reason is that we had better prospects for some commodities, especially soybeans from South America. And in the case of wheat and less so edible oils, there was the implementation of the UN-backed agreement that allowed, since July, exports of grains from the Black Sea region, and that sort of stabilized the global food markets. Just to elaborate a bit on the food commodity prices, again, as I said earlier, you see the skyrocketing of wheat prices to the left, which almost tripled, more than doubled. Maize prices, again, mostly because of weather issues in North America. Soybean price to the right, as I said, South America issue, weather issues. But rice prices, there has been some volatility, but compared to the other three commodities, have been, I would say, stable for the past year or so, the past 3 quarters. That's important. I will come back to this at the end of the presentation in a few minutes. because rice is the only commodity that did not face any issues, either weather, being affected by the war, or trade restrictions. We do not see much trade restrictions, many trade restrictions in the rice market recently. In terms of where we are heading this season on supply of food commodities, here we're showing grain supply growth and edible oil supply growth. That's year on year. We measure it in million metric tons. And the last bar to the right indicates the supply conditions of the current season. That is the season that began in August of this year. So this is an ongoing, and of course, those are forecast. They will be updated throughout the year. And we do see that in edible oil supply growth, because of very good weather in South America, we see the growth to be very large, exceptionally good compared to history. But we do see growth in grains to be negative this year, and that's because of it's affected mostly because of a shortfall in maize in North America. So we have very good news on the edible oil supply growth, but bad, so to speak, news on grains. Just to elaborate a bit more on this, on those two charts, each bar indicates the year-on-year supply growth of grains. So we have added tons of grains on the one hand and tons of edible oils on the other hand. Now, the red line indicates the long-term growth rate. So to the left, for example, you can see that each year the world adds 50 million tons of grains. So the world produces 50 million tons of grains each year, more than what it was producing the year before. So this is a kind of long-term growth rate. And of course, we see that for this season, grains is going to be the negative, bad news, but for edible oils, it's even above the long-term average. Now, just taking a bit of a longer-term look on food supplies, the chart to the left, what we have done is we have taken the 12 most important commodities, all grains and all oil seeds, and we are looking at the inventories and how the inventories of those commodities compare to consumption. So this is called, in the jargon of commodity experts, the stock-to-use ratio. So if this ratio is high, that's good news. There's plenty of production compared to plenty of supplies compared to consumption, and that exerts downward pressure on prices. If this ratio goes down, that's bad news in the sense that we have less production compared to consumption. And we see here how this ratio has behaved for the last 20 years. For example, between 2016 and now, we see that this ratio goes down, which means there are kind of bad news on the supply, but this is very little decline. It went down from 31% to 27%. Some bad news, but not as much. And that's, again, let's remember that is across all food commodities. Now, the reason I find this chart very important is that when we
Is this annual use or?
Annual. Annual, end of season. Those are end of season stocks compared to what consumption has been throughout the season. Yeah.
Season, like
the season from August to July. That's right. And for the last bar is for August that started this year until July of next year. So in a sense, this is a forecast. Yeah, it's a bit complicated chart, packed lots of things there. Now, what I would like to highlight here is that you can see that when we experienced the spikes of 2016-17, the spikes of 2010-2011, global supplies were in a much, much tighter situation compared to what we are today. So today, the global supplies of grains and oilseeds is not as bad in terms of inventories compared to back then. So if I could translate it into kind of more common language, I would say that based on this chart, the world can withstand a very bad crop, bad weather across many commodities and many countries before we're going to see the price spikes, the volatility that we experienced back in 2007 and 2011. Now, to the right, we see the trade restrictions. That's a an issue that has been discussed very often, both in the context of the earlier price spikes as well as in COVID-19 and the war in Ukraine. Because a lot of countries, especially food-producing countries, in response to the war and the high prices, they imposed export restrictions or many other types of trade restrictions. In this chart, we are showing the number of trade restrictions that were imposed since the war in Ukraine, 2022. We will compare them to the restrictions during the early stages of COVID-19, as well as the restrictions due to the food price crisis of 2008. So those numbers are not produced by us, they are produced by IFPRI, the International Food Research Policy Institute, which monitors very closely those numbers. And this is kind of interesting because today we have as many restrictions as we had back in 2008 in terms of numbers. However, the restrictions today have been applied to mostly smaller commodities and across the board. It's not like the restrictions that we had seen back in 2008, which had been applied mostly to rice and to a lesser extent wheat. And that's why the restrictions back then were much more effective in the negative, much harsher, and they affected commodity price much more than what they did today. So although in terms of numbers, the restrictions are very similar to what took place back in 2008, because it has been applied to smaller commodities, we have not seen the result that we saw back then. Now, I'm almost done. In terms of food price inflation, of course, high food prices that we experienced the past 3 quarters, last year rather, are translating to food price inflation. Here we are showing the food price inflation in the 6 regions, and this is the classification used by the World Bank. And we also show the World Bank Food Price Index, and that's a January to September change. South Asian region, SAR, is the one that has been affected the worst from in terms of a food price inflation perspective, more than 20%. And that reflects certainly Sri Lanka has a big effect on this number, on this aggregate, and to a lesser extent Pakistan, and less so I think India. But South Asia region is the one that has been affected the most. And those are average across many countries. Then we see that Latin America, Eastern Europe and Central Asia, Sub-Saharan Africa, and the Middle East and North Africa regions fluctuating around 15% in terms of food price inflation year to date for this year. Interestingly, the region to the right, the East Asian region, this region of the world, has not been as affected as other regions. It's a bit more than 5%, 1/3 of South Asia and about half compared to the other regions. And I believe a major driver of this is the fact that this is a rice-consuming region dominated by rice. And as I showed you earlier, rice is the only commodity or one of the commodities that was not affected, did not increase as much compared to other maize, wheat, and soybeans. And that's, in my opinion, in our opinion, the East Asian region has not, food price inflation in the East Asia region has not increased as much as in other regions. Lastly, I just wanted to conclude the presentation in terms of charts by showing you what happened in input markets and fertilizer prices, which has gained a lot of attention in the news the past year or so. Fertilizers are very energy intensive, especially one type of fertilizer, the nitrogen-based fertilizers, are made straight out of natural gas everywhere in the world, except China, which is made out of coal. So when energy prices, coal and natural gas price goes up, natural-based fertilizers go up. But all fertilizers have a strong chemical composition, other chemical inputs. So the moment energy prices go up, it affects pretty much fertilizer price across the board. And we can see here that the 3 price types of fertilizers that we are monitoring have doubled throughout the past year. And that has played a big role, of course, in the affordability of farmers. So far, we have not seen yield or at least the reports, I have not seen the reports indicating strong decline in yields because of less fertilizer use, but that certainly is going to affect the crop next season. Now, when we take the fertilizer prices and we compare them to food prices, and we have devised this kind of affordability index. We see when this index goes up, it means that fertilizer is less affordable, the reverse when it goes down. We see that affordability is worse now, as expected, but it's not as bad as it was back in 2008. So farmers cannot afford fertilizer as easily as they could prior to 2021, but the news is not as bad yet, and that's probably why we have not seen large effect or significant effect on yields. But if fertilizers go up, you can see there is here how the energy prices stay high, or they can spike them further. It's going to affect fertilizer prices, so affordability is going to become even worse. So that's it in favor of presentation. I do have a very packed table here. It just shows the forecast. There are a couple of numbers I would like to highlight. In 2022, for example, you can see that energy prices are going to be 60% compared to last year. Fertilizer prices 66% compared to last year. And we have in between 10 and 15% higher prices across the board on all energy commodities. And we do expect most prices to decline next year in 2023. There are only a couple of exceptions in some of the raw material prices. And huge risks around those forecasts, both coming from the macroeconomic side, darkening clouds on the growth side, appreciation of the US dollar, high interest rates, which makes borrowing very much expensive. So people are dealing in investment in the commodity or trading the commodities or having much harder time to borrow, or not harder time, they can borrow at much higher costs. And energy prices and the war in Ukraine is the big unknown that affects energy markets. To conclude, our reports, commodity markets outlook, our price reports, etc., are posted on the web, worldbank.org/commodities. You can download everything. In the report, you can download both the report, but you can also download the Excel numbers, or in Excel format. So each chart you see in the report, you can click in a zip file and you can download the numbers. If you have questions, I'm always one email away from you and I can answer questions. We can connect in LinkedIn where I post regularly for our activities. And those are the three products that we have recently. The Commodity Markets Outlook published on October 26th. We have a commodity book that we published recently. It was posted in May. A very long book that takes a look at commodity markets, especially evolution throughout the 20th century, and the commodity price data sheet to the right, which is updated once a month. Thank you very much. A very packed presentation.
Thank you so much for a great presentation. A quick introduction. My name is Tobias Pfützer. I lead the research group here at the World Bank Hub in Kuala Lumpur, Malaysia, and the research group here belongs to the East Asia and Pacific Chief Economist Office. So after this presentation, we now open up to a Q&A. So we invite our online audience to please post your questions through the chat on YouTube. Those questions will then be relayed to me, and we can give you a little time for that, a couple of minutes, so we can start with questions here with the audience in our seminar room. And let me just quickly open it up with a question. What I find really striking about your presentation is that the rice price has barely budged. And this is, of course, a rice producing region here. Do we know why that is the case? Is there just no substitution from wheat into rice, or is there just a very highly elastic rice supply, a lot of slack capacity?
Yeah, I have there are two sides to my answer. Again, there might be more than that. That's my feeling. The first is that we do not have bad weather events in rice, as we did in other commodities. For example, in soybeans, there was bad weather in South America. Then it was things were made worse by La Nina there. By the way, what I failed to mention is that we have La Nina for 3 years in a row, which does not affect commodity markets as much. It affects much less than El Nino, but the worrying part is that 3 La Ninas in a row. That's a bad sign in terms of weather change patterns, etc. That's why I to highlight this. So we do not have the bad news, the bad weather events that transpire in South America or North America. And of course, wheat was affected quite a lot rather, by the war in Ukraine. So the reasons that affected the other commodity price did not apply to rice. So that's in the short term for this year and last year. But my sense is that, unfortunately, I don't have numbers to back it up, but my sense is that after the 2008-9 and 2010-11 price spikes of price crisis, rice markets were affected the most, both in terms of yields, but most important in terms of production, but also in terms of trade restrictions. And my sense is that governments in this region invested much more in rice production first, and certainly restrained from imposing trade restrictions. And that's why we have seen this stability in rice prices. So it's a three-way answer. You have the weather that did not affect the price. You have the fact that governments did not engage in any restrictions, and probably governments have taken investment measures in rice to ensure that what happened in 2008-9 does not happen again. That's my take, but again, there might be other issues there.
Good, then, one question, Shafat.
So two questions. First is, you see a huge range in food price changes across the countries. So regions as well, but within regions as well, there's a lot of heterogeneity in how these countries, could this be linked to how open their agricultural sectors are? Because that could enable them to...
In part, yes, absolutely, yeah. Depending on if you have border measures, you do not let the fluctuations or the volatility from the world side to come into the country, absolutely, yeah.
And secondly, you said that the stock-to-use ratio for food items is at a level where you would not be very concerned about it, but I think it translates into 3 months of inventories, right?
At the end of the season.
At the end of the season.
At the end of the season. So at the end of the season, you have 3 to 4 months beyond.
But we've seen like these shocks, for example, with Ukraine-Russia war, things supplies can be cut off for more than...
That's right. You raised a very good point, and what I showed in the... Okay, it's fine. What I showed you is the global stock-to-use ratio, and my point was, I want to highlight what happens globally, but you raise a very good point, because the question is who holds the stocks. If a country holds the stocks, like in Ukraine, for example, they were having, when the war started, 20 million tons of wheat. It was there, but the world could not use it. So this is one aspect. Although with the UN-backed agreement, half of it found its way to the global markets, and hopefully the rest will find its way to the local markets. But that's one good example that this ratio is not sort of representative. And then the second aspect is that you have countries, especially there's a lot of talk about China and India, which have quite a bit of stocks there, but even if markets are tight, they may or may not release them into the global market. That's a good point. I mean, I take it very well, but globally the situation looks comfortable, but it doesn't mean that the stocks will be available at a short notice.
Even the most developed countries are very conscious about this.
Oh, absolutely. Yeah, absolutely. Agree with you.
Apurva?
Hey, John, thanks. Great presentation. So 2 quick questions. One is, how do you explain the fact that gold prices have gone down? Because gold is also typically considered a safe haven during times of uncertainty and volatility, like the US dollar. One. And second, I think in your second or third slide, the summary slide, and the downside risk, you have global growth going down and commodity prices going down as a result. And that was presented as a downside risk.
Yeah.
But if I'm a commodity consumer, like a big one such as India, for example, then low commodity prices are not a downside risk for me. They're an upside risk. So in what sense are low commodity prices a downside risk?
Okay, yeah, let me answer the first question, which I think the answer is quick. It's that, yes, gold prices, at least in my mind and in the mind of any economist, should be affected by inflation expectations, by concerns about the global economy, or concerns, or no, I'm sort of not concerned about the global economy, geopolitical issues as safe haven sort of investment, etc. And of course, in interest rates. I mean, you either invest in, you have many choices to invest, but one way you can invest in gold or you can invest in just cash. So if you have a higher interest rates, so you stay away from gold, less in gold, more in other money assets. And what we have found, in fact, we did a bit of econometric work, is that the interest rates dominate the price of gold. It's not the inflation or the geopolitical concerns that dominate the price of gold. This is a good question, and I was quite surprised. I would have thought that in a high inflationary environment and in geopolitical issues, etc., gold would not go down, but it did. As the charts show, and some econometric work we have done, which we have not published yet, its interest rates dominate.
And there are no supply issues on gold that you.
There are some supply issues, not that I would identify, at least in the context of this commodity markets outlook. In the previous one, there are some supply. On the physical side, you have issues typically in South Africa. It could be weather issues or strikes, etc., that affect the supply side. And then on the demand issue, it would be India and the Middle East. So those are the two regions that affect a lot the demand for jewelry, etc. In the context of this commodity market outlook, we do not find at least anything on the supply side to highlight. Now, on the second question on downside risks, I don't know, probably I have not used the right term. Downside risk on the price, I meant the price.
Okay, got it.
So that's, in the context of the commodity markets outlook, when we say upside or downside risk, we talk about the price. Now, when my colleagues talk about the global economic prospects, they use the term downside risks, they talk about the growth prospects.
Thank you. We have a question from Cheryl. How will the Ukraine conflict affect the sunflower oil market? Would you have any insight on that?
Yes, I do. I think we did quite a bit on this in our earlier commodity markets outlook. We had a long focus section in April where we examined a lot of markets, including the sunflower oil. There are 2 points that I would like to highlight. Ukraine accounts, I don't remember the number, but a huge percentage, like 50% or even more than sunflower oil supplies globally. So then one would expect that the market would be affected a lot. It has not been affected as much. And the reason is that when it comes to edible oils, there is strong substitutability across edible oils. Especially the four big oils: soybean oil, palm oil, sunflower oil, and rapeseed oil. And those oils account for, I believe, 80% of global edible oil supplies. So they're highly substitutable. So even though something happens to one of those oils, it doesn't mean that its price is going to either collapse or skyrocket. It depends on what happened for the rest of the commodities. And that's important in the context of this region for palm oil, which is highly substituted as soybean oil. So Indonesia often imposes an export ban of palm oil. Sometimes it affects the market, sometimes it doesn't, simply because it depends on the supply-demand conditions of the other soybean oil as well as the other oils. So it's the substitutability that sort of waters down the effects on the edible oil markets.
Thank you. Yes, Agustin?
Yeah, I have a question on the effects of commodity prices on the price of food prices. Did you also look at the subsidies and the heterogeneity across regions? Because maybe the reason why
East Asia
is so low, maybe it's just because they have
that's what I was going to say, but we have not looked at details in each country. But what I said, or I wanted to say, is that after the spikes of 2007, 8, and 11, most countries engaged both in investment to make sure, and perhaps in trade measures, meaning. But again, we have not looked at detail in each country. But that's my assessment. In addition, of course, to the fact that rice was not subjected to bad weather.
More questions? Do we have any?
Well, I have another one.
Yeah, go ahead.
I mean, basically, the question that I made at the beginning, if I understood properly,
Yeah.
your answer was that the shock, the demand shock, like dominates the supply shock, and that's why bad news reflect
Yeah.
in a reversal.
Yeah, let me elaborate on this a bit. This is the case mostly for industrial commodities. Industrial commodities respond a lot, of course, to income, to GDP and the global growth prospects. By industrial commodities, I mean everything except food, so to speak, and the precious metals detail. That includes also the raw materials, such as cotton and natural rubber, etc. Now, when it comes to food commodities, the global growth does not affect them as much because they have low elasticity, so the income elasticity. So when it comes to food commodities, it's mostly a supply side issue. And the decline that we have seen now is mostly reflects some good news on the oilseed side. We have bad news, but the bad news is mostly on maize, which is not, most of it goes for animal use, not for human consumption. And the fact that the UN-backed deal from Ukraine allowed the grain supplies to reach the global market during the past 3 months or so. So those are the two reasons for food. But for the industrial commodities, growth is a big factor. By the way, one point that we make in the book, which again is free to download, not a commodity reported book, is that we highlight there the issue of heterogeneity across commodities. That's very important to realize that some commodities respond to income, some do not as much, and other factors, etc.
Okay, thank you. Any more questions?
This is just a sort of casual observation that the food price shock in 2008 was much more severe than it is now.
That's right, yeah.
Do you have any insights into that, John?
My take is, that's why I found the stock-to-use ratio, this chart, which I have difficulties explaining, but back then, the big reason was that the global supplies were very tight. And when you have tight supplies, any other factor that comes in, it's what the economists call non-linearity, so to speak. So any other factor that comes in, whether it's an additional bad weather event in Australia, let's say, or the ban by Russia in 2010, some of you may remember it back then, or trade restrictions, especially on rice, that have a very huge impact on the market. But the big reason was that I think the markets were much tighter. At the moment, markets are tighter. That's why you have those sort of spikes or problems. And that's why I find this chart, the stock-to-use ratio global, it's important to put the whole thing into perspective. Understanding, of course, the fact that it depends on who holds the stocks, whether things can get out of Ukraine, etc., etc. It's important, but also having this global picture is important.
Right. And before Priya from the Edge beats me to this, I'm going to put you in the spot a bit. I mean, what sort of implications would it have for a country like Malaysia, your findings, in terms of Malaysia being a commodity oil price, commodity exporter, palm oil, etc.?
Mainly on the downside, there is downside on the price. That if prices go down, then it's the typical issues or problems that any commodity exporting country would face. Yeah, I mean, it's a simple answer, I guess. It's more to it, but.
Yeah, thanks, John. Just a couple of questions. One is like what Apuva just asked, but not on Malaysia, but on China. Mm-hmm. It's a big economy, so we have looked at it, right? Yeah. So what's the bottom line implications for China? That's one. But also, somebody who doesn't follow these things, my superficial impression was that all these commodity price hikes started because of the war in Ukraine, right? And, I was reading, it's the energy side from coming from Russia, and then, the wheat, coming from both countries. Yeah. So, hypothetically, what would the commodity market look like if it hadn't been for the war in Ukraine? Had there been other underlying factors that actually still would have created maybe some of these, less intensity, or is it really because of the war?
No, the answer is no. It's not because of the war only. The war made things worse, but if you look at the price changes, a lot of commodities began increasing prior to the war, so that's certainly the case. There is an issue, however, in energy, that certainly Russian supplies of natural gas, especially to Europe, were much, much tighter than what we thought from Russia. So Russia was restricting flows to Europe long before the war, I would say even 3 to 4 quarters. And in fact, when we were writing in the context of the October commodity markets outlook report of 2021, we did identify this as an issue there. So the short answer to your question is commodity price increased before the war, and the war made them much worse. In terms of price increase, but it added the risks also. It's a risk factor that the war added. And then
just the fact that the world had gone through some weird period because of the pandemic, right?
Yeah.
In the behavior change.
That was my next point. What we saw after the pandemic was a pandemic during, I don't know if it's after the pandemic is here with us, I don't know if I should use the term after, it's that we had a lot of supply chain issues in general. I mean, you all know what happened in car manufacturing, microchips, et cetera, but you also had supply disruptions everywhere in the supply chain, including commodity markets. So that also affected quite a bit. And we still have supply chain issues today. I mean, they have not gone away. I cannot give exact numbers, but when I have attended a few events lately where people from experts from the shipping industry talk, and they highlight the fact that we still have a lot of problems with supply chain issues. So supply chain is a major thing that boosted commodity prices. Energy, it was before the war because certainly Russia affected energy. And then you have the other issue that energy is used as an input to many commodities, especially food commodities, though so it affects them. And in the case of energy, we had weather affected a lot energy last year. Hydroelectricity, and in Europe, both hydroelectricity in South America, North America, and China. And in Europe, you had less wind, that wind power went down quite a bit. And that started exerting upward pressure on natural gas and coal prices. And that's before Russia started reducing supplies. Then you had Russia reduction supplies and the war. So I think it's a 3-step kind of step.
Okay. And China?
Now, China is the big question. What happens in China if the slowdown they are experiencing recently, especially in the property market, is a sign of a longer-term structural break, as a lot of economists and commentators believe. China consumes a lot of commodities, especially on as I said, almost 6% of global metal consumption, 55 to 6% of coal consumption. They consume even more than that, 2/3 or even 80% of some rare earth metals. And energy, they do not have such high shares, but they are still very important. Not very important on food, or at least as many people believe that China is very important, big importer of food commodities, but it's not. It's mostly on maize and some soybeans because of the animal, go to the animal kind of feed industry. So if the China slowdown is kind of a structural break or a permanent slowdown, then we can see prices of industrial commodities coming down. That's the biggest risk, I think, in terms of longer term for industrial commodities prices.
Okay, so if I heard you correctly, it's not that this trend in the commodity market is going to impact China, but whatever is happening in China will reverberate back
exactly.
on
That's
the demand side.
You placed it very nicely. Yeah, I assume that everybody knows this, but I'm glad that you elaborate on those issues. Yeah, thank you.
Thank you. We have one online question here, and let me see if I understand this correctly. It asks, almost all commodity prices will gradually be decreasing to the correct and right level. Do you think that this will impact less the recession, especially in Malaysia? So I think the idea is that, do you think that the commodity prices will quickly go down to their long-term prices, and will that, and will countries like Malaysia have some grace period that they can avoid a recession?
I will
In the
not,
intervening period.
I'm not an expert in Malaysia, so I would not go to the recession territory. I'm pretty sure there's plenty of expertise here, so I don't want to compete with anyone else.
Short answer is no.
But okay, thanks, everyone. Okay, thank you.
Good. Okay, and any projections about commodity prices, if they will go back to the long-term trend in the near future?
Well, we do have, in fact, we have in this table, which, no, I'm sorry, I'm looking at the table here, but it's not there. That's a good point. So we do look at long-term price trends, and for the next 3 to 4 years, certainly they're going to be higher than what they were the last 5 years. That's our expectation. Mm-hmm. So the short answer to the question is that we are going to face higher commodity prices in the medium term, let's call it 3 to 4 years.
Okay, thank you. So if there are no further questions, we are slightly over time already. Maybe it's time to wrap this up. So before we all leave and before you disconnect, please, the online audience on YouTube, there is a link in the YouTube chat to a QR code that will take you to a Survey Monkey, literally a 10-second survey on this event. Please fill it out. It's really quick and it would really help us to get your feedback. So very much for doing that. Again, it shouldn't be a very big burden. Everyone here in the audience, we have the same code up on the screen. Feel free to just scan it. And again, thank you very much, John, for a great talk and a great discussion.
Thank you very much, both to you and your colleagues and the office for facilitating that, especially on a short notice. And that was great, and I hope that we'll be here again in subsequent editions.
We're definitely looking forward to that. Thank you very much, everyone.